Hi, it's Aaron again from 1031 Specialists. In this video, I'm going to give you an overview of the entire 1031 exchange process. This will set the tone for the rest of our course. So let's get to it. For more than 100 years, the tax laws of the United States have allowed investors to defer taxes on the gains from the sale of an investment property as long as the proceeds are properly reinvested into a like-kind property. This legal form of tax deferral is governed by Section 1031 of the Internal Revenue Code. But what does like-kind exchange actually mean? In short, it means U.S. investment property for U.S. investment property. The property type itself doesn't matter, and we'll have more on that later. But simply put, a 1031 exchange is the swap of one investment property for another investment property without paying tax. And it's not just federal taxes that can be deferred. State taxes, investment income taxes, and depreciation recapture taxes can also be deferred. 1031 exchanges are how sophisticated investors limit their tax liability and maximize their real estate gains. A 1031 exchange transaction happens just like any normal real estate transaction, except for just a couple key differences. First of all, investors must hire a qualified intermediary like 1031 specialists. Qualified intermediaries are independent third parties required by the IRS to facilitate 1031 exchanges. Without one, you can't qualify for a 1031 deferred exchange. And second, investors cannot receive the funds from the sale of their investment property. This is a key IRS requirement. If money from the sale of a property touches your bank account, even for a second, the 1031 exchange is deemed ineligible. In a 1031 exchange, your qualified intermediary will accept and protect your funds until you're ready to purchase your replacement property. There are two deadlines you must hit to achieve a successful exchange outcome. Both have the same starting point, the date you close on the sale of your relinquished property. First, you have 45 days from the day you sell your property to identify potential replacement properties. These 45 days are known as the identification period. Second, you have 180 days to complete your exchange. Now, what does that mean? Well, it means you must purchase one or more of the property or properties you identified on your identification form. And title must be transferred to you by day 180. There are a few very important things to note. First, these deadlines are firm, regardless of whether the 45th or 180th day falls on a weekend or holiday. Too many investors make a huge blunder by not looking at the end date of their calendar, and it costs them dearly. Don't be like them. And second, you cannot go out and buy something that you didn't identify. What's on the identification form really matters. And finally, although the timeline starts on the day you close on the sale property, the exchange must already be set up before the close. If you close without it being set up, it'll be too late and you'll not be able to do the exchange. Many investors don't appreciate how many different options they have when it comes to a 1031 exchange. There are three primary types of 1031 exchanges. There's the forward, the reverse, and the improvement or construction exchange. There's also a simultaneous exchange, but these are less and less common. So first of all, the forward exchange. In a forward exchange, you sell one investment property and buy another within 6 months. The vast majority of 1031 exchanges done today are forward exchanges. Second, there's reverse exchanges. A reverse exchange is the opposite of that. You buy first and then sell one of your properties to satisfy the exchange. We see a lot of well-capitalized family office clients do reverse exchanges. And then third was the improvement exchange. The improvement exchange is when you invest equity to improve your replacement property. Now, which exchange you choose, it really boils down to your investment objectives, access to capital, and timing. And I would note that reverse exchanges and improvement exchanges require significant planning and time to set up, so please call your qualified intermediary well in advance. In our next lesson, we'll explain why investors should consider a 1031 exchange and do everything they can to avoid paying taxes when they sell an investment property. Whatever you need on 1031s, just ask. I'm Aaron at 1031specialists.com.